Hello and welcome to BQ Prime. I'm Hiral Dadia. Today we're going to actually discuss as to what's in store for Infosys and its shareholders, as the buyback has started yesterday and will continue for a maximum period of 6 months from yesterday, which will be executed, through open market. Joining us on the show today to discuss the modalities and what it means for you, we have Mahantesh, Sabarad, independent expert, as well as Rahul Jain, VP Research at Dolat Capital, joining in. Welcome to the show, gentlemen. Mahantesh, my first question coming to you is, firstly, in terms of the buyback, as we know, 1850 is the maximum price, 9,300 is the maximum offer that we're looking at. What's your first take on the buyback and what should an investor do?
So Infosys has been a regular company which has been buying back its shares for several years now, and it's not something which is new. But they've been switching between the tender route versus the open market buyback process. This time around, it's going to be the open market buyback process for them. Now, the price premium over the current market price is I wouldn't say is substantially large, unlike in the past. And the quantum of the buyback that they have talked of, not purely in terms of just the amount per se, but in terms of the percentage of shareholding, is relatively smaller. So I'm not very excited about this buyback that Infosys is going through, but it's a process they have been now undertaking for several years. So to that extent, that helps the company's balance sheet return ratios to become better.
Right. So overall, clearly, as you mentioned as well, I think this is the fourth buyback in the last 5 years, and 3 out of the 4 have been through open market. I think the one which was in 2017, wherein the buyback amount was around 13,000 crores and the price of 1150 was via tender. Rahul, coming to you, what are your first thoughts in terms of the buyback?
Yeah, hi. I think the buyback price, which is market driven, and the current market price, if you look at versus what it was for the last buyback, today we are broadly at 1600. Last buyback was at 1650, while the earnings have gone up by more than 10% in this period. So basically, the implied effectiveness of the buyback is slightly better than what it was last year. The quantum is similar, but the equity that would get nullified after the event would be slightly higher. So that way, the effectiveness is high. And the implied P for this kind of a purchase is coming out to be 26 times and lower. So that 26x or lower. So which I think is very similar to the kind of yield they generate. So it's not dilutive much like the previous buyback. And that way, I would say this is a good thing that they're doing a market buyback, and the price also relatively is better than the last time. So for me, it's a positive event.
Right. So, Rahul, how relevant and how significant will it be according to you?
I mean, to see this in an individual event, of course, it's not a big event, because even at the current price, what it would relinquish is close to 1.4% of the equity base. But how we have to see is over the period of time. If you look at the last 5 years and the last 4 buyback collectively would have taken away 8-9% of the total equity base of the company. So that is a perpetual benefit you get because your equity base get smaller over a period of time. The similar profits are divided over a lesser number of shares. So that is an advantage. The company, the residual shareholder gets after the buyback event. And we have seen in the Western world where some of the very high cash generating businesses with lower business requirement of the cash has been able to take away at least 30 to 40% of their equity base. I mean, the classic big example is Apple, right? The most of the return in Apple has come because of the buyback over a period of time while the earnings keep on rising. So I think that is what makes sense for a lot of this high cash generation business where the growth may not be very, very impressive. But over a period of time, you may have at least 7 to 10% kind of an earning growth. You have 2 to 3% dividend yield opportunity. And over a period of time, you reduce your buyback-led equity base, which also become accretive to the overall earnings. That way, it may good 12 to 15% kind of a return opportunity for the long-term shareholder.
Right. Mahantesh, coming to you now, since it's through market purchase, do you think it will actually essentially act as a support in terms of the stock price, taking into consideration the market scenario as well as what's happening on a global front?
Yeah, it indeed brings in that support in the market when it comes to looking at the share price movement itself, because you have a large buyer at the during the day who is constantly buying. Typically, they will buy towards the end of the day, but that assurance for a seller comes that there is some buyer out there who will buy the shares. It gives a support to the base price, no doubt. And we have seen that happen in the case of other companies as well. Infosys is not a stranger to this phenomenon. Even going by the first buyback that they did yesterday, they did it at 1615.5 odd rupees, which collectively they bought almost 200 crores of shares. That's pretty large in terms of a buyer available in the market. So it provides a base price till the time the entire buyback gets concluded.
Right. And Mantesh, overall, if you see historical stock price performance post buyback, I mean, let's take that as a consideration because that's more relevant from now. A 3-month performance we've seen in 2 of the 3 buybacks that have happened, where the stock has seen gains of almost around 12 to 14%, whereas it was in 2017 where we saw a degrowth of around 3% in terms of the stock price. Taking the current market scenario, or is there any historic trend where we could see an up move coming in from here on post the buyback?
So you're right in terms of your observation, and your observation is merely limited to only Infosys, but broadly speaking, for all the buybacks that you would collectively see, you will find that the tendency of the stock is to rise post the buyback event, simply because of theoretical consideration. A, your EPS goes up. B, your balance sheet return on equity looks better, and typically the buyback offer price is much above the market price which is there. So there's a big premium that you will typically find on the buyback price. All put together, all these phenomena tend to tell us that the share price typically ends up higher post the buyback event. And something similar should also happen if this theory is right, or is if the perspective of the theory works right this time around.
Right. And overall, if you have to see the correlation, Rahul, what would your view be? Because clearly, if you see in terms of calendar year 22, that has been a slightly weak year for Indian IT services, where the index is down almost 22% on a YTD basis. And there is a clear underperformance by, as compared to in terms of what markets have done. There has been some bit of a derating that happened to the sector as well, with EPS downgrades on the back of the recessionary fears and the inflationary pressures in the US and Europe. So, taking this entire modality into consideration, how would you correlate it?
Yeah, I mean, I would say that some of the price action post buyback would not be entirely driven by the buyback event. As I earlier also said, the buyback is happening closer to 26 times on a PE basis, which is similar to the earning yield the company is making on its other income. So that's why it's not changing my EPS estimate because of the event happening or not. So it does not changes my target price much because of this event. Of course, it has a long-term advantage. So that is point A. Point B, in terms of what has happened so far, does it really support? Yes, of course, if you have a large buyer at any given point of time, that is always positive for any stock in terms of supporting the price. In terms of Infosys performance in last 1 year, of course, this is the only company growing at 15% plus from a tier 1 camp and have stated guidance and have revised guidance upward during the year. So those things have definitely helped. So it's a bad year for IT in general, but relatively outperformance of Infosys has still come in because of more from the fundamental factor. And of course, this buyback support may be a small additional advantage to it. But as we all know that Infosys has clearly identified its payout policy, which is a collective of dividend plus buyback at 85% of all free cash flow. So I think these are no surprise anymore to the market because we know that there's a certain buyback window which has to be taken care of between the two buyback. There's a certain dividend per quarter or per annum or half yearly, whatever is the frequency. Those things are there. So we know that this is the total free cash flow which is going to be paid out to the investor over a period of time, over 12 months. If the dividend run rate is slower than that run rate, we would anticipate a big buyback, which happened this quarter as well. So it's not a surprise element to us. The only surprise nowadays is that whether it is a market buyback or it is a tender. And in case of Infosys, because the promoter shareholding is much lower, they don't have any constraint in terms of doing either. While some other companies with more than 70% shareholding, be it Wipro or TCS, they are somewhere forced also to think about doing a tender route because the promoters also are generally keen to participate in those rounds. So those kind of compulsion does not exist for Infosys. And the way the last two buyback has happened, I think they would resent to this market buyback only going forward as well.
Right. Mahantesh, coming to you as well, as Rahul was mentioning, yes, TCS and Infosys have clearly outperformed versus peers if you have to compare it to a Wipro as well as Tech Mahindra, because a 10 to 14% decline is what we've seen in the former versus Wipro, Tech Mahindra, a decline of almost around 40 to 44%. But now taking the second half of the year and say calendar year 23 into consideration, a lot of expectation with regards to, yes, a decline in revenue is what we could see, or probably a slowdown, or margins could improve, attrition is declining, the decision making at the customer end has slowed down as well. So taking all of this into consideration, plus a positive on the rupee depreciation, do you think from a valuation perspective, we could see something better, or do you think it's still expensive currently because we've seen a correction from the peak that we achieved in Jan 22, but long term seems to be expensive right now?
This has to be viewed from a relative lens, actually. And when I say relative lens, is not within just the IT set of companies, it is relative to the broader market itself, because the broader market this year has been performing, is going up. And although the valuations have not yet, I would say gone up simply because on the earnings side, there are certain downgrades that have happened. But all said and done, what you can see is that the market valuations are nevertheless going up. So from a relative lens, which I talked about, IT too needs to catch up from a valuation perspective relative to the other market segments. And that catch up, I would say, is happening. What is favoring the IT companies, which you did allude to, is that the margin contraction worry is no longer there. The attrition worry has somewhat subsided. The only worry now is on the top line and how the revenue kind of grows. But backing the top line growth, we also have large deal wins. The deal flow for most of the large IT companies still remains in a way intact. They've been growing upwards of 15, 17% per annum basis, on an annualized basis. So if you have large deal wins happening, deal flow pipeline is good, you have margins which are getting better, and you have these buybacks thrown in, you will generally expect the EPS for most of these companies go up, irrespective of whether these buybacks are market driven, or that is market linked, or they are through the tender route. So for the IT companies, this phenomenon from a relative lens perspective tells me that valuation should start getting better for them. And therefore, the future looks better for most of the IT companies.
Right. And overall, they've clearly indicated that 50% is what they propose to utilize, at least in terms of the maximum buyback, which would come to around 4,650 odd crores. Any comments on that front? Because currently a free cash flow of 4,752 crores is what they have in the second quarter, whereas a consolidated cash and investment at around 38,920 crores.
I think Rahul also mentioned about the fact that the free cash flow generation is there for shareholders, and it is returned to the shareholders close to 85%, and I don't disagree with that number. So when you have companies like Infosys throwing up such large cash, they will somehow find a route to reward the shareholders. If not the buyback, since the current buyback is in progress, once this concludes, the dividend method still exists for them to return the cash. There's another usage of the cash that the IT companies typically do is go ahead and acquire some large companies, but the appetite shown by Infosys in the recent few years in terms of doing certain acquisitions is pretty much low. And there seems to be nothing on the horizon, at least for now, for any big ticket acquisitions to be visible. So for the way ahead, for all that free cash flow generation does appear to be the dividend route now, and the utilization that you talked about in terms of at least 50%, I'm sure they will end up with that 9,300 odd crore number that they talked of. If 200 crore purchase is what they done in just one day, it tells you that the buyback should be over in 40-45 odd days. In fact, can be even lesser than that. The window available is actually 6 months. So in a matter of just under 2 months, you would have concluded the buyback straight away.
Right. So very lastly, Rahul, let me come to you. What would you advise an investor who has shares of Infosys to do? Tender on the buyback or stay invested?
I mean, as of today, our target price on the stock is close to 1650, and the current market price is not very different at 1600. So, from pure upside perspective, there's not much out there. Of course, most of our clients are institutional, and much of their investment are linked to the index weights. Infosys being a key component, they would continue to own it, although the absolute return could be not very significant from here on. And the next trigger, in our view, would only come once they come up in the Q4 earnings to talk about their FY24 forecast. That is what is the next big event that we are waiting for. So that way, we would say, in absolute basis, it's not a big buy for us, but relatively, we still maintain it as a preferred pick. And this is along with HCL Tech is our pick in the tier 1 space. So that way, relatively, we still like the name.
Right. And Mahantesh, what would your call be to investors with regards to the buyback?
It's very simple. None of these buybacks are really for investors to buy that. Much of the buyback is done also with the view that they've been diluting the equity through the mechanism of ESOP, and that ESOP needs to be absorbed. The dilution needs to be absorbed. All these companies, most of the IT companies, have a historic history of giving returns which are in excess of the market returns. So it never makes sense for me, at least, to offer any shares in the buyback. Incidentally, I hold Infosys in my personal portfolio.
Right. All right, gentlemen. Thank you, Mahantesh. Thank you, Rahul, for joining us on the show. That's a great consensus view that we have with regards to where Infosys buyback goes and what one as an investor should do as well, and the modalities in and around it. Thank you so much for joining us.
Thank you.